Can $100,000 invested in the three best index funds really let you live off dividends? Are you dreaming of a future where your investments generate a steady stream of income, allowing you to enjoy life's finer moments without the daily grind? The allure of living off dividends is strong, a promise of financial freedom that resonates deeply. You might be wondering, with a $100,000 investment in the market's top index funds, could this dream become your reality? Let's explore this intriguing question together, peeling back the layers to reveal the truth about dividend income and whether it aligns with your aspirations for a comfortable, perhaps even luxurious, lifestyle. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Understanding the dividend dream, your passive income blueprint. At its heart, the concept of living off dividends is elegantly simple. Companies that are profitable often choose to share a portion of their earnings with their shareholders. That's you, if you own their stock. These payments are called dividends. Imagine receiving regular income, simply for being an owner in some of the world's most successful enterprises. It's like owning a tiny piece of a vast, income-generating machine. Now, the key question is, can a $100,000 investment truly power this machine to generate enough income for your living expenses? The power of index funds, diversification and stability for consistent returns. When we talk about the best index funds, we're referring to investment vehicles that track a specific market index, like the S&P 500, which represents the 500 largest publicly traded companies in the United States, or a broader total stock market index. These funds offer instant diversification, meaning your investment isn't tied to the fortunes of just one or two companies. This inherent diversification helps to reduce risk and provides a more stable path for long-term growth and, crucially for our discussion today, dividend income. Think of it as planting seeds in a fertile and diverse garden. You're far more likely to have a consistent harvest. The Big Three index funds, core building blocks for your income portfolio. While there isn't one definitive Big Three, when investors consider core index fund holdings, certain types consistently rise to the top due to their broad market coverage and low expense ratios. Those tiny fees that can eat into your returns over time. These often include a U.S. Total Stock Market Index Fund. This provides exposure to a vast range of American companies, from the largest blue-chip corporations to smaller, emerging businesses. It's like capturing the entire landscape of the U.S. economy in one investment. An S&P 500 Index Fund. As mentioned earlier, this focuses on the 500 leading companies in the U.S., representing a significant portion of the overall market. It's a core holding for many investors seeking stable growth and dividend payouts from established giants. An International Total Stock Market Index Fund. To further diversify beyond domestic borders, this type of fund invests in companies across developed and emerging markets worldwide. It's about tapping into global economic growth and a wider pool of dividend-paying companies. Holding these three types of index funds can create a well-rounded and diversified foundation for your investment portfolio, aiming for both growth and that crucial dividend income stream. Decoding dividend yield, the percentage that dictates your income potential. Now, let's talk numbers. The income you can expect from your index fund investments is largely determined by their dividend yield. This is the annual dividend payment expressed as a percentage of the fund's current share price. For example, if a fund trades at $100 per share and pays an annual dividend of $2 per share, its dividend yield is 2%. Historically, broad market index funds like the S&P 500 have had an average dividend yield ranging from around 1.5% to 3%. Keep in mind, These yields fluctuate based on market conditions and the profitability of the underlying companies. Crunching the numbers. Can $100,000 generate a livable income? Let's be realistic. If your $100,000 portfolio of these big three index funds yields an average of, say, 2%, that translates to approximately $2,000 in annual dividend income before taxes. That's roughly $167 per month. While this is a start, for most individuals, this amount alone won't be sufficient to cover basic living expenses, let alone the lifestyle you may be envisioning. Bridging the income gap. Strategies to potentially enhance your dividend income. Does this mean the dream of living off dividends with a $100,000 investment is impossible? Not necessarily, but it requires a nuanced understanding and potentially a strategic approach. Here are a few factors and strategies to consider that could influence your dividend income. Reinvesting dividends for growth. While our focus is on living off dividends, initially reinvesting the dividends you receive can significantly boost your portfolio's value over time through the power of compounding. A larger portfolio will naturally generate more dividend income in the future. Think of it as using your initial small harvest to plant even more seeds for an even larger yield down the line. Focusing on higher dividend-yielding sectors. With caution, certain sectors of the market, such as real estate investment trusts, REITs, or utility companies, tend to have historically higher dividend yields. However, these sectors can also carry different levels of risk and may not always keep pace with the overall market's growth. It's crucial to conduct thorough research and understand the potential trade-offs. Gradual portfolio growth. As your career progresses and your savings increase, consistently adding to your index fund investments will naturally increase your dividend-generating potential. That initial $100,000 is a starting point, not necessarily the finish line. Supplementing with other income sources. It's important to consider that dividend income might be one component of your overall financial plan. It could supplement other income streams, such as Social Security, pensions, or part-time work, to create a more comfortable financial picture. The importance of expense management. The other side of the equation. While we've focused on increasing income, it's equally crucial to examine your expenses. The less you need to live on, the more impactful your dividend income will be. Take a close look at your current spending habits and identify areas where you might be able to reduce costs. This could involve anything from optimizing your housing situation to being more mindful of discretionary spending. Every dollar saved is a dollar less that your investments need to generate. Real-life perspective. Setting realistic expectations for your financial future. Consider this. Many retirees with substantial nest eggs still don't rely solely on dividends for their entire income. Instead, they often use a diversified withdrawal strategy, which may include selling a small portion of their investments in addition to receiving dividends. This approach can provide more flexibility and potentially better navigate market fluctuations. The key is to create a sustainable plan that aligns with your individual circumstances and risk tolerance. Building your dividend income foundation, a step-by-step approach. If the idea of building a future where dividends play a significant role in your income excites you, here's a practical step-by-step approach you can consider. Open a brokerage account. Choose a reputable brokerage firm that offers low fees and a wide selection of index funds. Many well-established platforms cater specifically to long-term investors. Research and select your big three index funds. Look for low-cost index funds that track the U.S. total stock market, the S&P 500, and the international total stock market. Pay close attention to their expense ratios. Lower is generally better. Invest your initial $100,000. Allocate your funds strategically across these three index funds based on your risk tolerance and investment goals. A common approach is to allocate a larger portion to the U.S. markets, but consider your own circumstances. Consider dividend reinvestment. Initially, for the initial years, consider enrolling in your brokerage's dividend reinvestment program, DRIP. This will automatically reinvest the dividends you receive, allowing your portfolio to grow faster through compounding. Track your progress and adjust as needed. Regularly review your portfolio's performance and your overall financial plan. As your portfolio grows or your income needs change, you can adjust your strategy accordingly. Educate yourself continuously. The world of finance is constantly evolving. Stay informed about market trends, investment strategies, and any changes that might affect your dividend income. The journey to financial freedom, patience, and consistent action. Ultimately, while a $100,000 investment in top index funds might not allow you to fully live off dividends immediately, it can be a significant first step on your path towards greater financial independence. The power of consistent investing, coupled with the magic of compounding and the steady income generation of dividends, can build a brighter financial future over time. Remember, building wealth and a sustainable income stream is often a marathon, not a sprint. If you found this exploration insightful and want to learn more about building passive income and securing your financial future, be sure to subscribe to our channel for more in-depth discussions and practical strategies. Like this video if it provided you with valuable information, and leave a comment below to share your thoughts or questions about dividend investing. We love hearing from you. Disclaimer: this video is for equipping, educating, and empowering and should not be considered financial advice. Investing involves risk. Always consult with a qualified financial professional before making any investment decisions. Your financial well-being is paramount.